Good afternoon. A very warm welcome to all of you. As you can see, I'm accompanied by Steve Cecchetti, the head of the Monetary and Economic Department. And before we take questions from you, I would like to highlight the main messages. In a number of crucial respects, the picture today is better than it was a year ago and much better than it was 2 years ago. The gap between world demand and productive capacity is closing. The global economy is growing at a respectable rate. In some economies hardest hit by the economic crisis, output is back to pre-crisis level. The resurgence of demand has put concerns about deflation behind us, and the international regulatory reform has proceeded speedily. The agreement of Basel III is really a major step forward. After 4 years, however, the financial crisis and the ensuing policy responses still cast long shadows. Global growth is uneven, as evidenced by the sovereign wealth crisis that have erupted in some countries. The threat posed by the unsustainable trajectories of public sector have materialized. With energy and commodity prices soaring, inflation has become a reality in many countries and a threat in others. In the crisis-hit countries, the repair of the financial sector balance sheets has some way to go, and excess capacity still burdens the financial and construction sectors. Financial systems remain vulnerable. And looking outside, the countries that were at the center of the financial crisis, we also see in several of these mainly emerging market economies in which domestic asset prices and credit is surging. And these are all too familiar signs of the buildup of financial vulnerabilities. And as these developments unfold, global monetary and financial conditions remain unusually accommodative. These developments raise serious risks for the economic outlook and financial stability, and they all reflect the challenges left by the financial crisis. The boom phase of the financial crisis has raised output growth beyond sustainable rates while masking sectorial distortions and growing vulnerabilities. The resulting imbalances now need to be rectified, and as they are, growth is bound to be slow. Policymakers should not hinder this inevitable adjustment. The overarching policy challenge is to build a solid foundation for robust, stable and sustainable growth. This requires urgent policy actions now, fiscal, monetary, structural and prudential, taking a long view to avoid larger costs in the future. All of these play a role in a new policy framework designed to ensure lasting monetary and financial stability. Let me say a few words about each of these, both the actions and also the framework. First, the need for fiscal consolidation is even more urgent today than it was a year ago. Pushed by commitments to aging populations, industrial countries' fiscal trajectories have been on an unsustainable path for some time. But the financial crisis and the response to it brought the fiscal reckoning forward. In countries that experience asset prices and credit booms, policymakers have begun to recognize the significant hole left by the collapse in temporarily inflated revenues. While fiscal problems are most apparent in the euro area countries, other major economies also need to manage their situations carefully and make efforts to consolidate fiscal positions quickly, not least because they have a big impact on the global economic conditions, financial conditions. Second, there is a need to normalize monetary policy. Globally, real short-term rates, already negative, fell further over the past year. Normalizing rates would reduce the incentives to take excessive risk and would support necessary structural and balance sheet adjustments. It would help restrain the buildup of financial imbalances in the economies where growth is more vibrant and continue to correct the current account imbalances. The more active use of macroprudential policies, measures in emerging market economies is welcome, but it cannot substitute for monetary tightening. Normalizing monetary policy can also complement the structural policies needed to move us away from the unsustainable combination of leverage-led and export-led growth. Third, excess capacity in the financial and real sectors must be addressed. In the financial sector, through a stress test supported by recapitalization measures, these tests are essential, but they need to be complemented by policies that reduce excess capacity in the financial sector and lay the basis for sustainable profitability. Without a stronger and linear financial system, it will be impossible to withdraw the extensive public support that still is in place. Fourth, Basel III needs full and consistent implementation worldwide. Beyond that, we need higher standards and credible resolution mechanisms for systemically important financial institutions. We must monitor and reduce the risks posed by the shadow banking systems, and the financial statistics also must be improved. The road ahead is likely to be bumpy. Making sure that the banks, financial institutions, are prepared for shocks requires building a strength now. So instead of, when it is possible, instead of taking the maximum time to reach the minimum standards, there is a good case for going faster and going further. Perhaps this is time when we can see a kind of virtuous race to the top. The more enduring lessons of the crisis, however, are not just about policy actions, but also about policy frameworks. Building a solid foundation for monetary and financial stability requires fiscal policy that builds up the buffers required for crisis management, monetary policy that actively supports financial stability, and regulation and supervision that has a strong macroprudential orientation. This framework necessarily rejects short-termism in favor of a long-term view, and it builds on the principle that keeping your own house in order is essential, but it is not enough. International cooperation will continue to be very critical. So thank you. This is just try to summarize the main ideas, and Steve and I will be ready to take your questions. Any question? Two questions. Please, go ahead. Yeah.
Thank you very much, Gabby Teasing from Bloomberg News. I do have a quick question about the capital surcharges that were, and I don't know whether you can comment on those or not, suggested by the Basel Committee. There is a question whether it was right that the Basel Committee decided not to allow COCOs into the capital surcharge rules it agreed for banks. So I'm kind of wondering whether you'd like to comment on that.
I think the comment is on the press release that was issued after the heads on supervision and governors meeting that was held yesterday. And basically there what it was said is that there was an agreement on the common equity that was necessary for systemically important financial institutions that will range between 1 and 2.5%. That COCOs are under analysis, and that can be used and are welcome as an additional element of absorption capacity for banks. So that's what COCOs continue to be on the table, and for additional element to absorb losses, it was supported too. So this is what basically it is in the press communique. There will be further analysis, further consultation. The consultative paper will be issued at the end of this month, and then, of course, work will continue. I think what it was important is that some of the uncertainty about what was going to be the common equity that was being discussed has been clarified. It will be between the 1% and the 2.5%. And again, COCOS can be used as an additional element of loss absorption capacity.
Thank you very much. My name is Mikio Sugeno from Nikkei, Japanese Economic Daily. Mr. Caruana, in your statement, there's a need to normalize monetary policy. In general, I can understand this word, but how can we understand in each cases? I mean that in general we can say so, but for instance, in Japan, it's a very, very tough situation to raise the rate. It is short term, middle term, we cannot leave. And the U.S. is still hesitating in your point of view. And also, the ECB has started to raise the rate. And also, emerging economies and central banks are raising the rate. But how can you, which group you can address this message? Thank you.
I think you said it properly. Globally, we think that policies should be normalized, and we have indicated that just looking at real interest rates, we have seen how interest rates were reduced over the last year, and we have seen that at the global level inflationary pressures have appeared. Now, this doesn't apply equally to everybody, as you have expressed, and this is obvious. It depends on many factors. It depends on the different circumstances of each country, and most importantly, it depends on the slack of the economy, of each economy. The point is that, all in all, still we continue to see that monetary policy is too accommodative for the situation, and that, and therefore, this is the idea that is behind the process of normalization. That doesn't mean that we are calling for raising rates in each country. This will depend, and we are not entering in this terrain. This will depend on the specific circumstances, on the slack of the economy, on the different elements that will be in the particularities of each country. Again, what it will be important to see is if when this process of normalization continues, because to some extent it has started, we end up having a global conditions that is not, as it is at this very moment, so accommodative. So we are making an analysis that is more global and not necessarily applicable in the same way to all the countries.
Sakari Swannen from news agency Reuters. To follow up on Gabi's question, what is the rough number of the global systemically important banks? Where do you think the number will be about? The numbers that we've seen in the public so far, roughly 30, are that close to what do you think they'll be?
I mean, the information that is available is the information of the press release that was released yesterday. It was important to agree on the methodology. It was important that now with this methodology, after the consultation paper will be applied, and there will be a number of banks. I have seen many figures, not very different figures from what we have been discussing, but certainly we cannot say, because these figures, the number of the banks that will be at the end, it will depend on what happened after the consultation paper and when all these formulas apply to the numbers. So I don't think that there is a number that I can communicate at this very moment.
Just to follow up, will the names of those banks be published once the list is final?
I think for the time being it is going to be published, the methodology, and it will be this methodology that will be applied to each and every bank. I don't think that, at least at the beginning, is the intention to publish the names of the banks. But again, what it is public is the press communique. I will refer to the press communique. There will be a new document that will be issued at the end of July after the Financial Stability Board has again looked at these elements. Any other question? Good. Thank you very much.